Most investors imagine their investment portfolios as structured vehicles expertly driving toward wealth accumulation. In reality, many portfolios more closely resemble crime scenes, littered with hidden dangers, overlooked threats, and unaccounted for risks. One pervasive culprit: variance drag phantom tax quietly eroding investors' returns. The heart of this issue lies in risk management, or more aptly, the lack thereof. Investors often focus on potential returns while paying insufficient attention to the volatility or standard deviation of their portfolio returns. A prudent investment principle is that a portfolio's standard deviation should ideally be no more than 80% of its historical rate of return. Yet, most portfolios dramatically exceed this threshold, creating unnecessary and uncompensated risk. This risk mismatch introduces variance drag, also known as volatility drag. Simply put, variance drag is the mathematical reality that high volatility systematically reduces compounded returns over time. Consider an investment with an average annual return of 10%. If the standard deviation of this portfolio is also around 10% or higher, actual realized returns due to compounding will often fall significantly below the average expected return. This difference acts exactly like a hidden tax, quietly yet persistently diminishing your financial growth. The situation is akin to trying to drive with your foot alternately slamming on the gas and the brakes. Excessive acceleration and deceleration don't simply average out, they create inefficiencies and friction. Similarly, heightened volatility introduces inefficiency and friction to investment growth, silently diminishing returns without ever appearing as a line item on your financial statement. Unfortunately, traditional financial advice tends to gloss over this critical detail, emphasizing expected returns without adequately addressing how volatility undercuts them. Investment managers who fail to incorporate rigorous forensic analysis into portfolio construction unwittingly subject clients to chronic underperformance. Portfolios become crime scenes, places where wealth quietly vanishes, unexplained and unaccounted for. At the heart of resolving this crime is financial forensics, conducting a detailed analysis that precisely measures risk against reward. Investors must ensure that their portfolio standard deviation stays disciplined, significantly lower than its historical rate of return. Doing so can dramatically reduce variance drag, preserving long-term growth and stability. The remedy lies in proactive risk management strategies, emphasizing asset allocation, diversification, and risk-adjusted returns rather than chasing headlines or the hottest market trends. Achieving this balance helps investors not just avoid variance drag, but actively turn their portfolios from crime scenes into well-managed, efficient growth engines. In investment management, knowledge and precision create power and prosperity. Understanding and controlling variance drag isn't merely an optional practice. It's the essential step toward achieving optimal returns without undue risk. Protect your investments from phantom taxes. The forensic tools to secure your financial future are readily available. It's time to employ them effectively.